Well, hello everybody, LA here. Welcome to 2022 and good riddance for the social aspects of 2021, probably for most of us. But the markets, what a different story. Those guys charged again. This is the 4 out of years running where you've had massive gains on the indexes. Same thing this year, right? Big, massive gains to the upside. If you look elsewhere, not so big unless you're in Bitcoin, which of course has had massive gains year to year, 4 out of the 5 as well. If you look at the sectors, same story, big gains across the sectors. And where was it? Mega cap tech primarily, builders, semiconductors, energy, technology, all of those were big winners on the year, although we had huge wins pretty much across the boards. But there's always, like a bad case somewhere. And if you look at it, James DePore, a colleague of mine over the years, he comes out with some interesting statistics saying, hey, just 10% of the stocks, 30% of the weight in the S&P 500, 25 of them, 50% of the weight. If you look outside those, half the stocks are trading, those that are $20 or less, 20% down. If you broaden it out more, 63% of all the stocks in the S&P 500 that are worth $10 or less, 20% down. Massive underperformance. And if I do my own query of the database, roughly 40% of all stocks close down on the year if you filter out the ETFs. So even though the markets had this massive year up, the vast majority of the stocks, right, did not. As a matter of fact, there's 40% of the stocks that were down on the year. Huge difference depending on what you're looking at. Since it's the beginning of the year, almost everybody does what they usually do, which is they go out and they start making predictions. Well, they're not worth the paper they're written on because nobody can see farther than a month, 2 months, maybe 3 months at best. What's important? Timing and trend is what we look at. Trends are mostly bullish. If we look at the long term, though, MTTFs are stretched. That says we're probably going to see some sort of a setback. Now, if we look short term, right, over here, we've got resets, and that means we could go higher 4, 5, maybe 6 weeks. And so if you think about it, what you're really seeing here is you're seeing short term, they've been down and now they're working their way back up. Intermediate term, they've been up and are starting to roll over. And long term, right, they're just kind of hanging up there. Now, you can't quite tell that from here. I'm pushing forward in the presentation. What you can tell it from, is these numbers. If we look here, right, long term, 41% still bullish, sideways 38. So there's a bunch of them that have gone up, hang up there, and a few of them have broken swing point lows and gone sideways. But for the most part, they're hanging up there. But if we look over at the intermediate term time frame, right, those are starting to weaken. You got about 50-50 now, right? And you got a lot of them in the sideways move. And so these have gone up, and you've got a lot of them that have broken, right, and moved to sideways. You've got quite a few that have broken 2 swing points. They're bearish down here. And you still got some that are up here. What are those percentages? Well, 29% down here, 28% up here, right? They're almost 50-50, and everybody else is in the middle, and most of those in the middle are heading this way. That's not a good thing. And unless that changes, that's going to impact over time what actually happens. Technically speaking, you can see it on the charts as well. NASDAQ, NDX, they have not done what the S&P has, which is to break out. And so you got a non-conforming case here, right, where one index has said we're going higher and the others have said not. Now, why is it important? Well, NASDAQ, NDX have been the leaders for the most part for most of the years over the last decade. And so the fact that they're not confirming is probably not a good thing. Now, this is a retest regen on the S&P on the daily chart. Should bounce, try to regenerate higher. If it doesn't, That's a big no-no. That's something to watch as we get going here in the new year. Turning our attention elsewhere, currencies. China did a huge devaluation back in December. That's this big spike down. Of course, they fixed their rates. Why did they do it? They want to boost exports, boost the economy. Makes sense, right? Make your currency cheaper, get everything moving again. That's what they're trying to do. We actually are going the other way, and that is that the dollar is trying to strengthen. It went up, broke a swing point high. You should see a retest regen, which is just about to do, and then an attempt to go higher. Now, unless it makes a fast move, it's probably not going to affect the equities immediately, but if it does make a fast move, this would be a problem. Look for it to trade over that 26 area in the first quarter. If it gushes higher, right, just spikes up, that's going to be a problem for equities fairly quickly. If not, they can absorb it for a while. Okay, looking elsewhere, how about bonds, right? There's so much debt in the system. Matter of fact, the reason, for the most part probably, that we've seen equities rise, we've seen prices of everything start to rise, is a result of all the debt that's being pushed into the system. And as that debt gets pushed in, right, we see more and more dollars chasing fewer and fewer goods, whether it be, stocks, whether it be real things like, the healthcare you pay for, the food you buy, etc. When we look at the bond market, right, bonds had a huge lift. When bonds go up, rates go down. Fed intervening is a big part of that. But what we've seen is we've seen them turn, try to bounce, come back down. It looks to me like they're going to break a swing point low, get back into this retest regen, probably get a bounce, and then turn down again. This is a monthly chart, but what it says is as these work lower, rates are going to work higher, and that's going to be a problem for everything that's out there because dollar-denominated debt is going to be having problems as well. As the dollar rises, etc. So I see this as an issue. How fast it's going to be an issue is a different question, but it's clearly an issue and something we can't ignore. And if we look at bonds in a different way, and that is from the investment grade, in other words, what can companies do in terms of borrowing? Can they borrow cheap still? They do that, and they fuel these huge buybacks. Well, that also looks to be breaking down. And if the price of these break down again, rates are going up when that happens, that's going to impact buybacks. Maybe not immediately, but over time. And so this itself, buybacks have been a huge reason for this market to rise. If that happens, that's going to be an issue. And finally, if we look at it, one other sector that has to do with housing, right? Mortgage-backed securities also. They've been tailing off as a result of both inflation and the Fed not buying as many of them. These are already back into a swing point high. I would expect that, and this is a monthly again, I would expect some sort of a regeneration attempt that's going to fail. They too are going to be a problem. So when I look from a debt perspective, right, rising rates are based on perceived changes both in tightening and inflation expectations, and rising rates are going to slow the economy and are going to create problems for the stock market. Which leads us basically to more of the fundamental things, which is inflation and central bank tightening. I don't think this is priced in yet. I think these corporate buybacks and earnings are more than fully priced in already. And expectations are that they're going to be very good. I'm not sure that's true, but we'll see. Elsewhere, we've got fiscal stimulus. We've got COVID probably ending as a result of this latest round with the Omicron. And then we'll have elections in the year. All these things are big factors that could cause problems to the market or could benefit the market. So if they all go well, market should benefit. And if they don't, market shouldn't. For example, this one is a big one that could probably go well, and it looks to me like it probably will. As for this week's numbers, OPEC, unemployment on Friday, Minutes of the FOMC, the last one on Wednesday, some PMI ISM data, and then more importantly, we've got some earnings data. These are kind of the earliest numbers that we can get to try to measure what these are going to do and the reactions to them. So that will be something important this first week of the year. Which finally brings me to the bottom line, which is, this market is poised for some sort of a larger sell-off, right? All the intangible factors that I listed 3-4 weeks ago, like margin debt, how great it is, how large it is, retail traders being involved. Usually you got to have retail before you get a major sell-off. All those kinds of things are there, right? What's missing is price. Price has not confirmed it. Price is not telling us this market's going to sell off. When it does sell off, right, it's just looking for an excuse. When it does, it's going to tell us that this is the case, right? And everybody's going to look back and say, oh man, we saw all this was in place, you should have known. Well, yeah, but it doesn't matter until it does. And right now it doesn't. And as a result of that, you got to err on the long side. You just got to stay with it until price confirms. What are the areas that are hot? These are the ones to me that look hot. XLP, XLU, BBJ, IGN, all those look good. What isn't? What would worry me? Well, I don't think I would be that involved in things that don't have earnings. And that's this whole group that I've listed here. And all of these technically are showing problems. So I would avoid, at least in the first quarter, these sectors. Is not where I'd be putting my money. I'd want to be focusing on things like this. Things that are showing me earnings, things that are showing me good charts. And speaking of that, if I look at the trading plan, about 50% invested. Deeper value type assets are the things I'd like to focus on to start the year. Some good dividend yields, things like what I just talked about, some pipelines as well. There's some small cap stocks that look solid technically, and a couple examples are here. And what I'm really looking for is things that have gone up. We're looking for a retrace to buy, or things that are trying to bottom, right? This is the bottoming case, this is the retrace case, and you can take a look at those. When they set up, I'll try to make a trade on them. Finally, weekly prognostications. I think the best case is this market is pretty flat. Worst case, tries to retest regen and fails right here and breaks down. More likely case, you actually get a retest regen that will try to regen, or at least begin to try and regen. And that is the way it looks on this first week of the new year. I'll be here each week, as I always do, telling you what I see, what I think, what I'm doing. Have a great one. Stay safe, and I will see you next time.